Okay, Jazz, I'm super excited that we're finally here at the table, and I know I've told you so much about Gabby, and it's really great to be here in your presence to share your knowledge about loans and the process of getting a loan. So I want to start out by asking if there's any particular questions that you have in mind that you might want to ask Gabby before we turn the table over to Gabby.
Yesterday we were talking about debt to income. What does that look like, and what would that have to look like to buy a home?
That's a good question. So debt to income is just a fancy way of the lender saying what you're approved for. And we look at what you pay currently in your revolving payments, credit cards, automobiles, student loans is a big one, any other lines of credit. And we add that to what your new potential mortgage payment will be. And then that is divided by your monthly gross income, and that's how we get that number. So if that number is over a certain threshold, then we have to reduce the purchase price in order to have you qualify. So that debt to income percentage is really just the way that the lender determines what payment and what purchase price you can afford when we look at what you're already paying per month with all of your other expenses. Because we want to make sure that you have the ability to repay the mortgage. That's the most important thing.
Since you brought that up, that's an excellent question.
Yeah,
It actually
really
is.
wondering
And
that.
often trying to explain that to my clients as I meet them, but I always refer them to the professional to explain it better. But one question I do have is, why does the current rent factor in to their, if they can get a home or not?
Oh, so that's a good question. So the rental payment doesn't impact that debt to income percentage, but it is a good thing if we see that they are paying rent. It is very helpful to the file. There is something called payment shock that an underwriter looks at, and if they're not currently paying rent or living rent free, or their new mortgage payment is going to be a lot more expensive than their current rent, that is a possible negative compensating factor that we look at to see if that new payment is going to be too shocking for a client.
See, I gotcha. I understand that. I just often wonder that, and this is a great opportunity to ask that question.
But it doesn't impact their ability to qualify.
Okay.
If they're renting now and going to buy, we assume that rent is going to end and that their new mortgage is going to kick in. So we never, unless it's an investor where they're going to keep having those payments while owning other property.
I see.
But if it's a primary residence, then we assume that that rent's going to end.
Okay. So Gabby, I would like I said earlier, take this time to turn the table over to you, and I'd like you to go over any incentives that your company's currently offering.
Sure.
Talk a little bit about interest rates and what they would look like. Talk about what, I know you sent out a link for people to apply, what that looks like, and what are the items they need to start getting together now, like she needs to start getting together now.
Yes,
So to make it seemingly easy to just go ahead and have all those documents ready. And
Yeah, so I'll start with that part of it first. So if you're looking to get a mortgage, I like to have an intro call just because it kind of gives me more context of like who you are, what's going on in your life. Sometimes we talk through things where maybe there's already a red flag when we talk, and so maybe doing an application isn't the very next step. Sometimes you need to work on things. But if we talk and everything sounds generally to be in a good place, then I'll direct you to the online application. We review our applications typically within the first business day, as long as your documents are uploaded. So those documents consist of your most recent 30 days of pay stubs, so income documents. We also need your W-2s for the last 2 calendar years. If you've been at different jobs, we need all of the W-2s. So sometimes that can be hard to track down if you've left certain employers. We also need your bank statements for the last 2 months because we need to see what kind of assets you're working with. That helps me understand what kind of programs we need to talk about. If you need down payment assistance or if you need to get a gift, so that opens up that conversation. We need your general identification to make sure that you're truly who you are. And those are, I'd say, the 4 main things: ID, bank statements, pay stub, and W-2s. Now, if you're self-employed, it's a different line of paperwork. We need tax returns and get a little bit more in depth with documents. But if you're not self-employed, if you're just hourly, full-time, or part-time, then the pay stubs and the W-2s would suffice.
Okay.
So it's your documents. That's generally what I tell people to prepare. And then after they're done with the application, we, if everything looks good, we start to go over the numbers part of it all. What do you qualify for? What is your payment going to look like? And what programs do you qualify for? So that's generally when we talk through all of the more specific numbers at that stage.
I do have another question.
Sure.
Okay, so I was self-employed for a while.
Mm-hmm.
I just recently got a job with the employer, doing the same thing, but it's just corporate now.
Sure.
I wanted to know, when I spoke to someone, they said that I would have to be on that job for a year before I could get my W-2s, of course.
Mm-hmm.
But how does that look, like being self-employed and then just getting a job? Like, why is it so?
Did you file taxes while you were self-employed? Okay. And how long were you self-employed for?
Since 2019.
I don't think you need to be on that job for a year. I think probably like maybe 30 to 60 days should be fine just to get some pay stubs, because when you go from self-employed to like hourly or salaried, that is a positive change, rather than the opposite. If you were salaried and you're going to self-employed, that's when
Makes
you
sense.
need more of like a year to 2 years history. It does restart that clock. But if you're in a stable income earning job and you have evidence that you were, like sometimes we have people that like say they were self-employed, but they don't have anything to show it. That's when you need to be on the job for a longer period of time, because we need that history. But if you have like tax returns and 1099s and things of that nature showing that you were self-employed previously, I don't think you need to be a year into it. I think, just a few months to show consistency and to show your earnings would be sufficient for that.
Nice. And just to give you a little bit of history about Jazz here, she and her husband make around 80 to 90,000 a year.
Perfect.
I did get her to go to the MyFICO.
Oh, good.
Yes. So their score is above 640.
Perfect.
And they have been paying off their credit cards and stuff, so they're trying to position themselves into the right spot.
Yeah, lowering that debt.
Yes, yes. So she's curious about the pre-approval and what that will look like, and the time frame if she was to be pre-approved, about how long it would take.
Yeah, that's a good question. So I think it sounds like all of your ducks are kind of lining up. Your credit being over 640 is great. That's what I generally coach clients to be over, just because there's more incentives available to them. With the state, we have a state program that gives down payment assistance and reduced interest rates. And that one is 640 and above credit score wise. You can get approved as low as a 580 credit score. However, the risk factor in the file is a lot higher, and it's harder to get that approval. So 580 is your minimum, but I always tell people if they're working on their credit, try to aim for 640 and above. So I think you're great in that range. Reducing debt is so important because it helps your buying power increase. So the less payments you have per month, the less revolving debt that you're paying per month, the more your income will allow you to qualify for. So we call it buying power, because without that, you'll have an affordability problem. Brenda knows this on the real estate side. Real estate in Charleston is not as affordable as it once was. What you can buy for $250, $300, $350 is not what you used to be able to buy. They were under $200. They were $150. So prices have drastically gone up in the course of real estate, and so because of that, we're having first-time home buyers really have affordability issues with trying to make a home purchase successful because of that. So by reducing your debt, you're giving yourself a way better opportunity of what you can buy.
Yes. And so they have been saving some funds, Gabby, but they may need a little bit of help. So her parents are willing to give them a gift.
It's great.
fund. So could you talk a little bit about what a gift fund is and how to handle it? Because often people think if they just put cash in their bank account, that's good,
Right.
and it's really not.
Right.
And then the difference between down payment assistance, and then closing costs.
Yeah, absolutely. So gift funds are great. They are very common in mortgages. A gift is something that somebody, like a family member or significant other, is giving you without expecting you to repay them, basically. So there's no loan attached to it. There's no repayment attached to it. It's just, I'm giving you this money and here you go. You can absolutely put it in your account, but we'd like to see an account to account transfer. Unfortunately, cash is not verifiable in the mortgage world. Cash is not king. Cash is unsourceable. So it is always looked at as a red flag when it comes to underwriting. So we don't want you to take like a big heap of money and cash money and deposit it into your account. So from account to account is best. And we can use that just with the gift letter. So we just get a gift letter verifying who's gifting it to you and what the amount is. So very easy. When it comes to the difference between down payment and closing costs, your down payment is going to be a set percentage, basically, depending on what kind of loan type you're doing. So if you're doing a conventional loan, which means you have, decent credit, that it's 3% as a first-time home buyer. If you are doing an FHA loan, which caters more to our lower income or lower credit score clients, then 3.5% is the down payment. If you're a veteran, there's no down payment. And if you're living in a rural area with a USDA loan, which is much less common, that one also doesn't need a down payment. But your down payment is your deposit on the loan, and then we finance the rest. So it's the minimum requirement from you as a homeowner. And then your closing costs, you could pay your own closing costs, or you can have the seller negotiate with your agent to pay some or all of your closing costs for you, if that could be negotiated into the deal. Sometimes it can, sometimes it can't, depending on the seller's opinion of that. Or you can get some of these great programs, which here in South Carolina we have SC Housing that helps with down payment assistance, but it could also go towards your closing costs. It's kind of like flex money, so you can use it however you need it. And so they have some great programs that can get you $10,000, $12,000, or sometimes more in assistance, which really helps first-time home buyers a ton, because I find that a lot of first-time home buyers have the credit score and they have the income, but they don't have the down payment, or they don't have the closing costs. So those programs help tremendously when it comes to bridging the gap between renting and homeownership.
And that's, Gabby just basically went through the 4 types of loans and also explained to you the difference between down payment and closing costs. And so you won't be alone in this. And she'll be helping you with any kind of down assistance programs, and I'll be helping you try to work with the seller to negotiate. So there is a possibility, depending on each individual circumstance, that you could come to the table with little to no money.
Yeah, absolutely. We've seen it time and time again. So you do have certain things that you pay out of pocket that your realtor goes over with you, like your earnest money, your home inspection, and your pest inspection, but everything else is included in the lender's closing cost breakdown. And really all of that, some of that or all of that can be paid for by some of those programs and assistance programs, or by a seller helping you. So there's really, like you said, there's a way to make it work with people that need all of those, costs covered for them. Or if you're getting a gift, that's great. Then we could pivot your gift towards like your down payment and try to get the rest of that stuff covered through another way, so that you can keep your money focused on the down payment.
So obviously you're in a pretty good spot as far as credit and income right now. I mean, Gabby will assess you and let you know what your buying power is. But Gabby, just for me, I would like to ask, do you have some kind of program, or do you work with someone that if their credit isn't quite where it needs to be, something that you could do to
Yeah, so we do have an unaffiliated partnership with a third-party company. They're not affiliated with our company directly, but I have a great relationship with them. They're a credit readiness program, so they look at you as a full picture. They look at your credit, they look at your debt, and I can absolutely connect you to them. I have a portal to kind of see how my clients are doing with them and how their progress is. I will say credit improvement is so tricky because you have to be motivated to do it. Like we as your helpers in this, as your lenders and your realtors, can't want it for you. And I think that's where we see a lot of fallout is people say they want to do it, or they seem motivated, and then we get them to somebody that can help, and then they don't do it, or they fall out, or they procrastinate, or whatever it is, because it's sometimes harder to I think like do the effort. But yeah, that's where we see a lot of fallout. Is when people when we give them the steps and then they just disappear, or they don't do it, or they don't call the person back. You know? So we do have all of those channels, but you have to be motivated to do it yourself, because we could tell you what to pay off and how to save money and all of those things, but it takes self effort to actually do all of those things. So that is the disheartening part when it comes to credit improvement, because you give everybody the tools, but then they don't use them.
And so here's one of my tips is, if you find yourself in a position to where you had to navigate away from that plan, don't just get discouraged, and don't just get disheartened and start ghosting us. That's the time when you really need to reach back out and let us know we had to do this, and it's okay. Like, we can figure a way how to get around that. But if you don't tell us and you ghost us, then we can't help you. I guess I just want to know a little bit more about what the interest rate is right now, and then anything you want to add.
Sure.
Because this has been great. Are you getting? Yes. Okay.
So interest rates right now are, this current week of March 12th, we'll date ourselves, we won't say the year, is a little bit turbulent, just because we're having a lot happening in our world right now, you know, when it comes to turmoil, military wise and economically. So when big events like that happen, it generally doesn't have the best impact on the mortgage market. So the mortgage rates, I'll give a little bit of background just to give you some enough information to be dangerous with interest rates. So, you know, the stock market, right, moves up and down all over the place. The bond market that drives mortgage rates moves exactly the same way. A lot of people think there's just like one set interest rate or one option, and that's simply not the case. You know, so the bond market is impacted by inflation, it's impacted by economic and, you know, global events, it's impacted by politics, it's impacted by it's risk. It's really, when you boil it down to, it's how much risk, you know, is happening in the world and how that impacts how the bond market moves. So this particular week, interest rates have gone up from where they were. They were under 6% about a week and a half ago, and now they're comfortably in the low sixes, with some cases even higher than that, depending on your credit score and your loan type. That's still great though. I'm gonna be honest. Like, I've seen 7s and 8s and, you know, for the last couple of years. So low 6s to mid 6s is still a great range of interest rates. Where we don't want to see it going again is back into the 7s. I feel like that bred a very unstable market. And so we just hope that it doesn't kind of reach that again. But this year they have said they're not going to be cutting the prime rate like they were last year. And so we don't expect a big decrease, you know, this year. So I would hope that they continue to stay in the 6s. Now, if they do go up, it will always be temporary. They will always come back down. We just don't know exactly how or when that will happen. But there's always a settling after a raised market. So it's always just kind of your luck of the draw of where rates are when you go under contract. You know, you can try and time the market as best as you can, but sometimes it's not about timing the market. Sometimes it's just about buying the house and then realizing that you can always refinance down the road, or you could always sell. There's a lot of options available. And a lot of those incentive programs that we talked about actually have reduced interest rates. Right now, those rates are under 6% with those incentive programs. So I try to sling those as much as I can to people who qualify, because that is a great way to get a lower rate. So that's my mouthful of where interest rates are. So
Okay.
It's very interesting.
So you talked earlier about the 4 types of loan, the conventional, FHA, VA, and the USDA loan. And speaking in terms of interest rates, to get a conventional loan, it's not really government backed, right? But an FHA, a VA, and a USDA is. So how does the interest rate affect, like, if your credit score was high enough to get a conventional loan? What does that look like?
Yeah, I will say, like, so conventional loans right now they're generally about a quarter, sometimes more higher than those government loans. VA is like your best price loans. USDA isn't too far behind, and then FHA is, pretty low as well. But they have some additional fees on them on the FHA than what you have on conventional. So it's not always like gonna give you a lower payment than conventional. It just depends on your scenario. But conventional rates, those are the ones that are, like, I would say between that range of like low to mid 6s. And then for a good, decent credit score, FHA and VA are a little bit lower than that. So it just depends on, like, if you have a 580 credit score, you're not gonna have a 5, or a 6% interest rate on FHA. It's probably gonna be a lot higher because it's based on credit score, even on the government loans.
Wow, that's a lot. That's a lot to take in. And a lot of people get confused with, so that's why I wanted to bring up those type of loans, because sometimes they ask me about Ginnie Mae and Freddie Mae, and those are the secondary mortgages, which if you get one of those government loans, your loan is more likely to be sold to one of those companies. I just wanted to say that in general, because your loan will most likely be sold if you're
Every loan is sold. Yeah, and that's the thing a lot of people they're like, oh, is my loan going to be sold? Yeah, every loan is sold to a servicer. And some people self-service their loans, which is fine. But in general, when we are approving somebody for a loan, we are conforming to the rules of that loan. And the rules are set by those big secondary markets that Brenda referenced. Fannie Mae, Freddie Mac, they back the conventional market, and Ginnie Mae backs the government market, which is your FHA, your VA, your USDA. And they set the rules of what is allowed lending-wise with those different loan types. So if I tell you, you can't be self-employed for 2 months and get a job and get a loan, that's a rule that they make that we have to adhere to. So every loan is conforming to the guidelines that are set out, and it's not my rules as Atlantic Coast Mortgage or any other bank. Some people think, oh, well, if Gabby said no, I'm going to try this other bank. The rules are the rules, whatever the loan type is, but if you have a good loan officer, a lot of the times we could find ways to make it work with the rules. So every loan conforms to those guidelines, and every loan is sold essentially, to a servicer that you pay every month. Like, it's a great example. If you go to CarMax to get a loan, and let's say you get a BMW, are you going to pay BMW or you're going to pay CarMax? You're going to pay CarMax. So just because you have a BMW, aka got a loan with Gabby, doesn't mean that you're necessarily going to pay me. You're going to pay the servicer where you got, your loan from.
So before I ask Gabby to really tell us a little bit more, because I want you to know about her company and any kind of incentives or any kind of services that we have not talked about already, as a conclusion, and also to give tips of what to do and what not to do while you're in the loan process. Do you have anything else you want to add to that?
Not right now. I'm just listening.
Okay, that's fair. So Gabby, we want to turn it over to give you an opportunity to tell us about your company and anything else you want to add.
Yeah. So we're Atlantic Coast Mortgage. We are a a boutique lender. That's how I like to explain it. So I'm not a bank and I'm not a broker. We are specialized mortgage loan advisors that aim to give you a white glove customer service experience. We are not going to treat you like just another number. When it comes to being a client, it's very much a specialized process because every single client is different when it comes to getting a loan. No two scenarios are the same.
Never.
Which is why I love what I do, because everybody is different, keeps me on my toes. But we're based out of the Fairfax, Virginia area, but we cater all over the United States, particularly the Southeast. I'm licensed in 4 different states, so I can help cater to people in South Carolina, North Carolina.
I didn't know that.
Yeah.
And I've been working with Gabby. If she can get it done, if she can do it, it can be done.
It can be done.
Yep.
That is true.
Yes.
That's true.
It can be done.
So we can help you in lots of different states, and we have great incentive programs in all of those states. So it just depends on what kind of services you need. But I would say in general, like if you're looking for a customized experience that's going to help you feel empowered about the process, that's what we really specialize in. And then when it comes to do's and don'ts in the mortgage process, like Brenda asked, we send out a list of things. The game Monopoly, like don't pass go, like don't do this. Yeah, all of that. So we tell our clients, don't try not to make any large employment changes when you're in the loan process. If you have one that's coming up, let's talk about it. That's a big one. Another big one is let's not switch our accounts around a ton. Let's not move a lot of money in between accounts. Let's not deposit a ton of cash into our accounts, because when you're in the underwriting process, you're under that underwriting microscope where everything is scrutinized in terms of, why did you move this money here, or why did the cash go here? And so, let's try not to do that. Don't take out any new debt. So don't go buy a new car. Don't go get a new furniture credit card for your house. Don't do any of that. You can use your existing credit cards, but we just don't want you to take out new debt, because that could impact your loan quite heavily. And I would say another really big one is, I know everyone likes to go on vacations and do things, but if you are gonna leave, definitely let your lending team know, because we need documents from you and you need to sign paperwork. And so if you kind of go off the grid, that makes our job harder. So that's just a general courtesy update.
Yeah. What about making late payments?
Yeah, don't do that. So late payments, they could immediately kill your credit, and we do monitor your credit when you're already under contract. So if your credit were to go down, sometimes it could absolutely unqualify you for that loan. So I would say try as much as you can, even if you could just make the minimum payment. Please don't miss a payment. Missing a payment is, worse than taking out new debt, truly, because credit is driven by your ability to repay things. And if you're not paying things back, then it is saying to the credit bureaus that you're not being a reliable credit user. So definitely make your payments on time as much as possible, even if it's just a small credit card, or none is more important than the other. Auto loans, credit cards, they're all equally important, even if it's a $30 card. Yeah.
So I thought we were going to finish, but you mentioned underwriting.
Yeah.
And because during this process, I just want to tell you up front, they're going to look at your surface and give you a pre-approval or send you to a credit repair program of some sort. That doesn't mean you're qualified. So they're going to be digging deep down to find everything they can, and you will be getting, because a lot of times people take it personal, like, why are they asking me this? They already asked me this and this. It is their process, and it is, like she said, rules and guidelines that they have to follow. So they have to continuously, and I refer to it as little mosquitoes biting you, but just have all your stuff ready and to go as they go through these steps or phases, which I know there's at least 2 phases as you're doing the whole approval process.
Okay, so when you are starting the mortgage process, we kind of let you know what to expect, at the next stages. So after you go under contract, we get your initial loan disclosures out to you, which is going to be the official terms of your loan. They're pretty lengthy. They're about 80 to 90 pages, but they're all electronic, which is good. So we kind of lead you through that, let you know. It goes over all of your fees, your interest rate, your payment, all of that stuff. You review it and sign it. It shouldn't be anything different than what we've already talked about as your loan officer. There shouldn't be any surprises. At that point, we submit your loan to what's called our processing department. Your processor's job is to be the liaison between you and underwriting. So you'll never talk to the underwriter. Just think of them as people in a dark room, that you'll never have to, with computers and all of the things. Underwriters will never directly talk to you. They're there to make an unbiased credit decision and to review your loan to make sure that it complies with the guidelines and the rules that it has to comply with. So your processor is the one that'll be communicating between you and underwriting. They'll review your file, make sure there's no documents that we're missing before we submit it to underwriting officially. The underwriter will then review it and give you what's called a conditional approval. And that's basically saying, yes, you are approved. Everything looks good so far, but we need this list of things before I can give you final approval. And those list of things, some of them are third-party things that we need, like insurance and title, employment verification. Some of them are for you. Sometimes we see a deposit on your account and they want to know what it is and you need to show proof of that. Sometimes people have changed jobs and we need an updated pay stub, or maybe you missed a W-2. So they'll give you a list of things. Ideally, in a perfect world, we get all those things and submit it back and we get what's called a final approval the week of closing. Sometimes it's a little bit more complicated than that. Sometimes we have more complicated buyers and it takes going back and forth to the underwriter a couple of times to get things straightened out. But ideally, like Brenda said, we're just going back once or twice through underwriting and then you're ready to get your final paperwork, make sure all of your loan terms are what you expect, that your payment, is the same, your cash to close is the same. And essentially you get to review all of that about a week before closing to make sure that you're happy with everything. And then you get what's called your clear to close, which is that final loan approval. And that's the exciting part. That's when we all go, yay!
We all breathe.
And then don't buy a car after that.
Yes.
I generally have had clients ask me after they got a clear to close, okay, great, I'm gonna go buy my car now. I'm like, no. We have to sign the paperwork first. So then you go to the attorney's office and you sign all your paperwork on your closing date as per your contract. And then you get the keys after the loan is funded and you get to own a home at that point. Then you can buy a car. Yes.
And you usually get the final document 3 days. You have to have 3 days, right?
We do. We send it a week ahead of time, just because, again, we're giving you more of a specialized process. 3 business days is the minimum amount of time that you have to sign it before closing legally. So sometimes people get it a week before and then they forget to sign it. And so I'm like, hey, you need to sign your paperwork so we can close. But yeah, generally we always send that out a week before to give people enough time to review it and not feel rushed to review those things. Yeah.
Nice. That was great, Gabby.
Awesome.
Is there anything else you want to?
No, I think in general, home buying, I think people think it's really scary. People think that it's really, lenders are scary, or, idiots, and some of them are, but depends on who you work with. Yeah, right. But in general, if you find a good team that can have your back, really give you a pathway to success, it might be right now, it might be in 6 months. I always just try to encourage people as much as I can not to feel, let down if they're not ready right away, and to continue to work on it, because home ownership is a great pathway to independent wealth building. And everybody deserves that. Whether you're single or married or with kids or whatever your family situation looks like at any stage of life, investing in real estate is a wonderful decision, especially in the market that we're in.
Right, absolutely. So how do you feel?
I feel great. I feel empowered.
Good. Good.
That's good. That's good to know. And I don't want to toot our horns, But as Gabby said, finding that right team. And I know that I strive hard, and I know Gabby strives hard. And we have attorneys and special others, our inspectors and all the people that we work with. I've been working with them for years, and so you found that great team. And so I want you to feel like anytime you have any questions or concerns, you're more than welcome to reach out to any of us.